Well, g'day there, traders and friends, market participants and enthusiasts right around the world. Thanks a lot for joining me in this weekend market update. It really has been a tale of two tapes, so to speak, over the past 5 days worth of trading. You can see on my screen right now the Dow Jones Industrial Average, even on Friday, closing up another 66 points. If I change to the weekly chart for you, you can see that over the past 5 trading sessions, the Dow Jones has closed up very close to its all-time highs. It's actually broken above its all-time highs and also at the highs of the weekly candlestick, closing up just over 260 points. The reason why this has been, so to speak, a tale of two different tapes, it's really because the S&P 500 has been more or less stuck in the mud. You can see if I change to the weekly candlestick here, it isn't that of a long day Morobozu candlestick over 5 trading sessions. It resembles more so that of a doji, or what we call a spinning top candlestick. We are within the previous week's range worth of trading. If I also change the picture, change the chart to that of the Nasdaq, you can see also it was actually a negative week, down 23 points. And again, this is coupled with, of course, that high wave spinning top, which we saw 2 weeks ago. Now, the last video which I brought to your attention, it was essentially titled Danger. And the reason why I was calling it danger, an immediate danger anyway, at least for a trigger, was because of the deterioration that we saw with the transportational average. That divergence in price, where the industrial average continues to grind to the upside, it has moved somewhat parabolically over the past maybe 2 weeks, is certainly different from the tape of the transportational average. What I'll do, I'll bring it up for your attention, or to your attention now. You can see that the purple line on my screen here is the transportational average, whereas if I change this to the dark closing line in terms of price, you can see this is the industrial average. Now, this is what we call divergence. You can see that towards the end of July, we started to see these two lines separate. Now, again, we have to pay close attention to this. It isn't necessarily an immediate warning signal. However, if we see continued deterioration in the transportational average, if this over the next 5 trading sessions, maybe even 2 weeks, continues to roll over and turn down, well, then this is a major warning signal for that of the industrial average. What we're essentially seeing right now is a non-committal market. Yes, this market is resilient. Yes, it is strong, and we have made a ton of money over the past number of months trading this recent breakout to the upside. You can see on my screen here with the industrial average, we've had bullish call option contracts on the DIAs, for instance, starting all the way back at 21,243. You can see subsequent entries as this bull market has continued. Our most recent bullish entry was all the way up here at 21,700. We closed above 22,000. We closed at 22,092. So first of all, what I would encourage you to do is to really lock in those profits. So what you can essentially do is start thinking about moving your stops up even to the low of Friday's candle, if not Thursday or even Wednesdays, if you wanted to, of course, begin taking some of those profits off the table. The reason why we say this again is because the S&P is failing to continue at this particular point. It doesn't mean, or it doesn't necessarily mean, that it's not going to continue. We do have some bullish triggers and continuation triggers to the upside, which we're still keeping a very close eye on. Same for the Nasdaq, but really what we're seeing is essentially back tests going on after some of these recent breakouts on the Nasdaq and also the S&P 500. However, again, the transportational average at this particular point is a major warning signal. If I bring up that chart again, just to show you this, what we have seen is a little bit of a stabilization in terms of price. You can see that really we sort of fell off a cliff, so to speak, throughout the month of July. We pushed up, we made a new all-time high. We were looking at a potential bounce out of this green box. We were looking for a bullish continuation, something like this above 9,560. We didn't actually get it. Instead, the bottom fell out of the market, and it appears as though this is some form of a rounding top, and that this may potentially be some form of a whipsaw on the transportational average. Now, again, going back into more so the molecular level of what has happened over the past week, we're starting to see price rebound, especially on Friday. You can see we closed up 75 points on Friday, and the reason for this is because we're starting to retest both the 100 and the 200 simple moving average. Now, again, this is the long macro trend of the overall market itself. Now, we have been stuck in a rectangular sort of consolidational pattern for a number of months. This is dating back to December 2016, and really what happens around the 100 and the 200 simple moving average here is really going to sort of unlock, I guess, the sentiment and also the likelihood of either these markets continuing to the upside, much like the industrial average, or whether or not we're going to see some form of a correction take place across these markets. Now, I don't have to really go into much detail in terms of just how overbought they are, but I will show you it in due course relatively soon. But before that, again, you can see price pulling back into the rising 200 and also the sideways moving 100. So this is essentially the test or the retest of key support. In the past, when we've hit the 200, you can see the immediate bounce which we've seen in terms of price action. If we go back to 2016, you can see over here the 100 simple moving average, and again these two over here acting as support, and you can go back and more or less see where the trend begins to shift and where these macro trends either continue to the upside or begin to break down if you go back historically and see what happens once price starts pricing in lower lows, and also seeing these simple moving averages act as resistance instead of support if we definitively break down below them. But again, this is all sort of unknown at this particular point. Oftentimes when we retest the 100 and the 200 for the first time in a number of months, we will see short-term buying. It's just a matter of, I guess it's a question, so to speak, as to whether or not we can sustain these levels, eventually break back above these resistance areas, which were once support, temporarily support once we broke above it. And if we can start to see some consecutive closes above 9,450, above 9,600, and eventually above the swing high over here, just below 9,750. Now, going back into the overall markets, you can see if I start bringing up some of these oscillators as well, you can see just how stretched we are. The stochastics is quite elevated. The RSI is giving us a print just shy of 85. And again, on the S&P 500, the same picture. You can see some of these divergences in terms of price establishing themselves. And again, if I go to the NASDAQ, you can just see how elevated we are on this market. Now, again, the NASDAQ and the S&P 500, it has been stuck in the mud. We haven't seen any continuation to the upside, but this is due to the reset which is going on with the oscillators. So as these continue to pull back, as long as we remain above these support levels, you can expect these markets to continue higher. Now, if I bring up these exponentials, you can see we're just sort of trampolining at the moment all around them, especially on the 10 and the 20. If I bring up the S&P 500, you can see that also right on that 10 exponential moving average. They're starting to flatten out, which is a little bit concerning. We really want to see this trend continue relatively soon. Otherwise, we are set for a longer sideways moving pattern, or even potentially a pullback if we start to see the cracking of those exponential moving averages. But again, the outlier at this particular point is the industrial average. You can see it more or less exploding to the upside. It's pulling away considerably from both the rising 10, 20, and 50 exponential moving averages. And when this happens, you have to assume that that ADX is going to be quite elevated as it is. So you can see we're getting a print over here at 45. What you should do is go back historically and measure this for yourself and say to yourself, or at least ask yourself the question, what happens when we start to see the ADX registering levels where we currently find ourselves on the daily chart? Because again, that will unlock a lot of questions, or at least answers for you in terms of immediate price action. And I would encourage you to take the time to actually do that little exercise for yourself. Outside of that, everyone, you can see also on the Russell 2000, this is more so talking about market width or breadth, is that again, very similar to that of the transportational average. It looks as though we're getting some form of rounding top. Now, a couple of weeks ago, we were very excited about the prospects of this market continuing to the upside. We had bullish continuation triggers above 1,453. We didn't hit them. We pulled back down, and in fact, we've closed below on Thursday this green box. Now, we've temporarily sort of spiked our head, or pushed our head back up into this green box. And I mean, it's still 50-50 as to which direction the Russell is going to move. But if the transportational average is any indication of where potentially the Russell is going to move, well, then look out below, because we may have some targets down here at 1,390, and even potentially a retest of this primary bullish uptrend, which is coming in on this red extension over here, this trendline extension, which is printing in just shy of about 1,375. So there's a little bit going on in the markets. Again, the news and the sentiment is extremely bullish, and when it is, and when it does sort of move into that very one-sided, type of directional sort of sentimental understanding of the market, and at least the bullishness of the market, you need to sit back and start dissecting it a little bit more, I guess in more clarity, so to speak, and understand, well, where are the realistic sort of directional objectives as to where price action can move to, and how do you set yourself up to take advantage of those directional movements? Now, I've just recorded Pro. We went through this over 90 minutes in that recording. It is up on the website, and we do have a lot of interesting trade setups for the week upcoming. This also extends to gold and silver. Now, I've been speaking a lot about gold and silver over a number of months, also in relation to the US dollar. These are at critical sweet spots, so this is exceptional opportunity for a lot of people. if you understand how to break down markets through the eyes of a technician. In fact, silver's already triggered below 15.49. And also what is interesting, if I bring up the price of the US dollar, you can see that we've been in an absolute free fall over the past number of months. We've actually stabilized around that macro support area. I've got these two lines, these sort of horizontal lines drawn on my chart. There's a lot of congestion down and around this area on the US dollar. And again, if you think about the US dollar moving into extremes in terms of oversold, have a look at these oscillators, just how oversold they are. Again, if I just bring up the ADX, you can see it turning down definitively. So this is saying that potentially the short-term sort of exhaustion of this bearish wave is done. What that means is that there's a high probability that the US dollar is going to reverse. It's going to strengthen over the next couple of weeks, if not couple of months. It's still sort of debatable and a little bit contentious as to whether the long-term macro trend is going to continue or whether or not this is sort of the topping price of the US dollar over sort of the macro term as well. Again, that will sort of reveal itself in due course, but immediately right now on the molecular level, the minor level, what we look as technical swing traders is that if the US dollar is looking to strengthen over the coming weeks and months, well, then you can expect silver and gold to actually decline. So it flies in the face of a lot of sentiment at the moment in terms of the US dollar, also with gold and silver. But again, we're at that critical sweet spot for commodities. That also extends to that of oil as well. And it's something to be aware of as well, because there is a tremendous amount of tradable opportunity given, of course, just how weak the US dollar is, where it's located on the chart, and what that means for commodities which are priced in US dollars. If you're interested also in learning about individual trade analysis, how we apply technical analysis to individual stocks, we've just transitioned through earnings as well. It's a great time to have a look into that pro analysis class. So on that note, everybody, I'd like to wish you all a nice weekend. If you have any questions, email me, success@pivotpoint-trading.com. And I'll see you all next week for some market updates. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Goodbye.